Okay, I think we can get started now. Welcome to our webinar, Optimize Your Income, a tax overview for established professionals and business owners. I'm Terry Zavitz of Zavitz Insurance and Wealth, and joining me is Justine Zavitz. Zavitz Insurance and Wealth specializes in providing holistic insurance and financial planning solutions by working with our clients to understand their vision, goals, and overall financial picture, and building unique solutions to complement that picture. Throughout this presentation, feel free to use the chat line to ask any questions, and we'll get to those questions during the presentation and after it if there is no time to do it during. So in today's webinar, we'll focus on conversations we often have with our clients who are incorporated or considering incorporation, that of how to optimize income, starting with an overview of taxation of salary versus dividends, why some dividends are better than others, and strategies to keep your corporate tax rate down. We are not accountants and will not be giving tax advice. Everyone's financial situation is different and requires professional advice as to the most favorable way to structure your business and how to take income. When we work with our clients, whether doing insurance, financial, or estate analysis, we present general concepts that may be of beneficial use and send you to your lawyer or accountant to implement the best plan. So let's get started with the salary and dividend debate, likely the most common conversation we have. The most important concept to know when considering taxation of income is the theory of integration, in which the goal of tax legislation is to keep the taxation of various types of income equal, although it may not always appear this way. Let's go through an example of earning $200,000. If you are incorporated and take a salary, the salary is considered an expense to the corporation and therefore is a deduction and no corporate tax is paid. You pay tax personally on the salary received, and you also have to make Canada Pension Plan contributions. In total, the tax and CPP contributions are $71,496, leaving you with an after-tax income of $128,504. Now let's assume that you take a dividend from your corporation. And for this example, we'll use an ineligible dividend, a type of dividend available to many small Canadian businesses, and one that we will explain later on in this presentation. The corporation, after expense, has a profit of $200,000. If you take the corporate tax rate for an ineligible dividend of 12.2%, it leaves $175,600 of after-tax corporate income. If you take that $175,600 as a dividend, you personally pay tax of $46,411, leaving you with $129,189, similar to the after-tax income if you had taken the $200,000 of salary. So note that Canada Pension Plan contributions are not required on dividend income. But that also means you would not qualify for the Canada Pension Plan benefits upon retirement if all of your income received during your working life was dividends. So here it is, the salary versus dividends and the theory of integration at play. The net income after tax is basically the same. So there is more than one type of dividend, and understanding the difference between them is important in understanding the theory of integration and corporate taxation in general. Dividends are either ineligible eligible, and capital. So let's just take a look at them. So an ineligible dividend comes from money that has been taxed in the corporation at the small business tax rate. The small business tax rate is 12.2%. But when you take the remaining after corporate tax money out as an ineligible dividend, the highest marginal tax rate on that money is 47.74%. And just to be clear, not all corporations qualify for the small business tax rate, but a lot of them do. And if they qualify for the small business tax rate, the first $500,000 of after expense profit gets the small business tax rate of 12.2%. So let's move on to an eligible dividend. An eligible dividend is paid from corporate earnings that do not qualify for the small business tax rate. We call that the general tax rate. And that tax rate is 26.5%, so much higher. But when you pay a dividend out on that after corporate taxed money, the tax rate is much less at 39.34%. So if I take the example of a corporation that does well, that has an after expense profit of 700,000, the first 500,000 is taxed at 12.2%. And the remaining money from that 200,000 or from that 500,000 then is subject to an ineligible dividend when taken out and taxed at the 47.74%. The remaining 200,000 that does not qualify for the small business tax rate is taxed at 26.5%. But then when you take that money out, it's taxed less at 39.34%. So that takes us to our last type of dividend, and that is a capital dividend. And a capital dividend is the kind of dividend that we all want because it's tax-free. So it comes from two sources mainly. If you have a capital gain within your corporation, you know that when you have a capital gain, 1/2 of the capital gain is currently taxed and the other half isn't. So that other half that's not taxed has to come out of the corporation as a capital dividend, which means, again, that dividend does not incur tax at the personal level. Now, similarly, life insurance proceeds above the adjusted cost base also come out of the corporation as a tax-free capital dividend. And it's one of the reasons that many business owners hold life insurance within your corporation. And you may wonder what I mean by adjusted cost base, and it's a convoluted type of explanation. But let's just give an example. Let's supposing you have a $100,000 term insurance policy in your corporation. You pass away, the $100,000 would be paid into the corporation tax-free. The adjusted cost base of that policy as a term policy is virtually negligible. So the $100,000 not only would be paid in tax-free, virtually all of it could be paid out tax-free as a capital dividend to the shareholders. So let's look at the eligible and eligible dividends in practice. So we've shown salary, we've shown ineligible dividends. Let's take an after expense corporate income of 200,000 that's taxed not at the small business rate, but is taxed at the general tax rate, which is much higher, leading to a corporate tax rate of 53,000. That leaves 147,000 for you to take out of the corporation. The tax rate on that money personally is $20,000, leaving you with $127,000 rounded. So that's the theory of integration. Whether you take salary, ineligible, or eligible dividends, at the end of the day, you end up basically at the same place. And again, I remind you that when you take dividends, dividends are not subject to Canada Pension Plan contributions. And so therefore, you don't pay the contributions, but nor would your income for that year qualify for Canada Pension Plan benefits upon retirement. So I'm now going to pass it over to Justine to delve into the factors that influence your corporate tax rate.
Thanks, Terry. So as Terry mentioned, there's these two tax rates inside your corporation. And so she touched a little bit on the fact that the first $500,000 of most corporations receives the small business tax deduction, or the small business tax rate. And so the question is, how do we find ourselves with that general tax rate versus small business tax rate? And do we really care is another great follow-up question to it. So there's a few major factors. One is that we're earning too much money. So if you are earning after expenses more than $500,000 in your corporation, then that first 500 will get the small business tax rate at 12.2% in Ontario. And then the rest of the money over and above that 500,000 is taxed at the larger tax rate. So that's factor number one. Factor number two is you're not considered something called a Canadian controlled private corporation. So only Canadian controlled private corporations qualify for the small business tax rate. As the name suggests, it has to be a corporation controlled by Canadian residents, and it has to be a corporation that is not a public corporation or controlled by a public corporation or non-resident. So that's factor number two. And then factor number three is passive income. And passive income is investment income, or income that is being earned inside the corporation, not from your active business practice. Investment income tends to be the primary source of this. So for every dollar of passive income that is earned inside your corporation over the $50,000, so you can earn up to $50,000 of passive income before you're impacted. But every dollar over $50,000 is going to reduce your small business tax deduction, that $500,000, by $5. So once your passive income is $150,000 or greater, the small business deduction will reduce down to zero. So those are the three major factors that are going to dictate which tax rate your corporation will be taxed at. So the next question is, do I care? And as most things in the world of finance, it really does depend. What stage of life are you in? Are you at the beginning of your career with a negative or $0 net worth that you're trying to build up and accumulate? Or are you nearing retirement and you've accumulated this wealth and you're now starting to think about the decumulation phase of your life? So we're going to look at an example again of a person, age 35, who's incorporated and now has the ability, now has $150,000 of corporate profit that they do not need to take personally, that they will be able to save in their corporation for future years. So at the beginning, this person qualifies for the small business tax rate of 12.2%. Obviously, they don't have too much passive income because they've just started saving. So that $150,000 of taxable corporate income results in $18,300 of tax. So that's going to leave $131,000 to be saved. And we're going to assume that we earn a 5% rate of return on these savings. So obviously in the first year, from 10 years before where their net worth was zero, they've doubled down and they've had 100% growth in their net worth. Not bad. Let's fast forward 10 years. So every single year, this person has been saving away $131,700 and has been earning 5% rate of return. So 10 years later, this age 45 person is still subject to the small business tax rate. They haven't started earning enough passive income that it has clawed down the small business tax rate to something that's 150,000 or less. So over that 10 years with the compounding interest, this person now has a pot of money of 1.5 million almost, 1.45 million. From the 10 years prior, when they only had 131,000, their net worth gain in this time is 91%. It's hard to beat 100%, so this is still pretty good. Let's fast forward now another 10 years. So now this person is age 55. And over that time, their passive income has started to exceed 50,000 and exceed 50,000 to the extent that the small business deduction that their corporation will experience is now less than 150,000, which is the amount that the corporation is being taxed on. So as of age 54, the passive income is great enough that the small business deduction is being reduced. Now, some of that 150,000 is taxed at 12.2%, whereas the rest of the 150,000 is taxed at 26.5%. So at age 55, they have a blended tax rate between the two, resulting in $26,534 of corporate tax in that year. So we're starting to see the tax rate in the corporation creep up. Now, this person is still accumulating net worth at a fairly good pace, despite this creep in the tax rate. They now have a pot of money of about 2.75 million. Their net worth gain from the 10 years previously, they still increased by 52%. So at this point in time, with 2.75 million, yes, no one likes to pay extra taxes. However, is it really going to be impacting your future retirement goals and the ability for you to continue to accumulate net worth? So we're going to, again, fast forward another 10 years. Now we're at age 65. And by age 59, so in that 10-year time frame, at age 59 is when the small business deduction has been ground down to zero. So from age 59 up to age 65, that 150,000 of taxable corporate income is now incurring $39,500 of tax, which is reducing the amount that can be saved every single year into this pot of money. Still able to save quite a lot, still able to save about 111-ish thousand. And that is bringing their net worth up to now 3.8 million, which is a 29% growth. So we're starting to see that the growth rate is slowing down. So we've reviewed all sorts of numbers here. What is the actual moral of the story here? And it really comes down to the short game versus the long game. When you're younger, the lower tax rate coupled with compound interest is helping you accumulate net worth at a much faster pace. And as younger individuals, that tends to be what our goals and ambitions are, is to try to increase our net worth as much as possible. As you get older, despite the compound interest on a larger pot of money, our tax rate is starting to slow the pace of the accumulation, and we don't see our net worth increasing at quite the same level. However, as you get older and closer to retirement, our focus is starting to shift from accumulating our assets to decumulating them. And how are we going to do tax planning during our retirement to ensure that we are able to find the best mix of assets? So what is nice about having an eligible or higher tax rate in your corporation at some point in your lifetime is that you are accumulating eligible dividend capacity. And when it comes time to decumulating your assets in retirement, you'll have more tax planning capabilities. So of the money that you had stashed in the corporation at age 65, about 1.5 million of that is going to be money that can be paid out at the eligible dividend tax rate versus the ineligible dividend tax rate. So that will start allowing you, again, that greater tax planning capability within your retirement in your decumulation years. Hopefully everyone followed through that, but I will remind you that if you have questions, please pop them into the chat. So what are some ways that we can look at keeping our corporate tax rate lower, especially in the early years? Well, one thing that we see often when we're working with professionals is if you have a couple, a married couple who are both in the same field, they might incorporate together to save themselves a corporation fee. Now, when you have a joint corporation, you are accumulating assets at a much quicker pace, which will drive up your passive income quite significantly. You're a lot faster within that corporation. But you also might be earning enough money together that the corporate profits are surpassing the $500,000 as well. So a single versus a joint corporation is something to consider short-term and long-term. On top of that, we look often at cash value life insurance. So cash value life insurance is a policy that will allow for the buildup and the growth of money inside the life insurance policy on a tax sheltered basis. So instead of taking your money and investing it in an area that is going to increase your passive income, you can invest it inside a life insurance policy that is not considered passive income inside your corporation. We also consider individual pension plans or personal pension plans. These are kind of like an RRSP that you put inside your corporation. They allow your contributions are tax deductible, which is going to reduce that corporate income that you're being taxed on. But also all of the money growing inside the pension plan is tax sheltered and therefore would not be considered passive income. And finally, employee benefits, or not finally, second last, employee benefits and or a healthcare spending account has two purposes. Number one, it's going to help you to attract and retain talent within your corporations, but also the benefits that you pay for on behalf of your employees and yourself as an employee of your corporation are a tax deductible business expense, which can again bring down the amount of taxable income in the corporation. And finally, one other thing that we like to look out for is whether your corporations are associated with any other corporations. So you are associated if you are the shareholder of this company and the shareholder of this company, or if your corporation is a shareholder of another corporation. So holding companies will cause you to be, your operating company and your holding company will be associated. And so there are times when those corporations are associated, and that just means that you share the small business deduction. So if you have three corporations all earning income that are considered to be associated, then you're sharing that $500,000 amongst you. And also the passive income of each corporation is associated. So if you have a holding company, typically it starts to invest quite a lot of capital and that will drive up your passive income, which will impact your operating company. So we have touched on a lot of things today. And surprisingly, that was just the tip of the iceberg. There are a lot of other areas of a corporation that we haven't touched on. Things like having your kids as your shareholder, which might make sense now, but might not make sense if your kids choose to incorporate once they are through school and starting their career. We didn't talk about trusts, which can be a great planning vehicle. We did not talk about holding companies to a great extent. And we did not touch on capital gain stripping. But we wanted to keep this as simple as possible and as short as possible, recognizing that we're all spending time here today together. And we wanted to make sure there was lots of time for questions. So if there are questions, please feel free to pop them into the chat and we'd be happy to address them.
So we did get a couple of questions that were sent direct to us. Maybe Justine, you can answer this one. And it says that I invest any profit, after-tax corporate profit in my corporation. And I wondered how tax is done on investment income.
Great question. And in my example, I certainly didn't take into account the tax on the investment inside the corporation because I didn't want to get that complicated in that example. However, in your corporation, the passive income, the investment income that is being generated is taxed at close to your personal tax rates. So if you were to incur interest income as a highest marginal tax bracket individual, you pay about 50% tax on that interest income. That is the same inside your corporation. And dividends and capital gains are taxed also at the same rate. So capital gains, if you incur capital gain as an individual on the highest marginal tax bracket, it's about a 26% tax rate. Same with inside your corporation. However, once you pay that tax, you are credited into this other notional account. We call it the refundable dividend tax on hand credit. And just to complicate things, there's the non-eligible refundable dividend tax on hand credit and the eligible dividend refundable dividend tax on hand credit. So we call them NERDTO and ERDTO. I don't come up with these things. And so once you pay yourself a dividend out of the corporation, whether it's an ineligible dividend or an eligible dividend out, then you get credited back some of the tax that you paid in the corporation on that investment income. If we were to have an example of this, putting the theory of integration into work again, then you would find that once you've paid it out to yourself and had that refunded tax in the corporation, it again is fairly close to what you would have paid had you just invested that money personally.
And just another way of looking at it is that within your corporation, all investment income is taxed at the highest marginal tax bracket. And then when you take the money out, it's subject to tax again at a dividend. So it makes sense, like you say, Justine, to be credited some of that tax back because you've paid this extra tax. And so that's what your heir to and near to is the tax that is credited back to the corporation. It's pretty well why we have accountants.
Exactly. Yes. And we pay them, good hourly money.
Yeah, to make sure that we take advantage of everything that is available in keeping our tax rate low. It reminds me that it's important for everyone to understand and have a net worth statement. And we do a number of net worth statements here, and we will ask people what they have in their RRSP or the IPP. We'll ask what they've got in corporate savings, in their TFSA, and any other non-registered savings. And out of that, we have a net worth. And then from that net worth, if someone is going to retire, we have programs that help give a general idea of how to withdraw money from their assets that they've got in order to best optimize tax and provide the retirement income that is needed. But one thing I think it's very important to note is that there is all sorts of tax. So if you have an RRSP, for example, and you retire, the money that you take out of the RRSP is totally taxable. If you have a corporation and you're drawing money from the corporation in the form of dividends, and they're an eligible dividend, that money that you take out is taxed less than if it was an ineligible dividend. And if you take money out of your TFSA, there's no tax on that money at all. So when we do our analysis of retirement income, what we try to do is minimize the amount of tax by layering income. Always remember to turn off your phone. So by layering income so that any money that you get to begin with that has to be taxed is considered and then reduced from there. But my point is that when you take a look at your net worth, and if somebody bothers to share their net worth with you, remember that we never take into consideration how much of that net worth is taxed. So if I'm dealing with two people that have a net worth of $1 million, one that is all non-registered money with tax that's already paid, and one that $1 million is made up of corporate savings plus RSPs, when you look at the after-tax amount, it's quite a bit different, and that determines taxation. And where am I going with this? When we talk about corporations and the fact that you have income that's taxed at the lower tax bracket of 12.5% or 12.2% versus the 26% that you have at the general rate, you never want to pay that extra tax when you're working, but it's way better to have the higher taxed money in retirement. So it just depends on where you are in your life.
Right.
So with that, I don't see any more questions. So I thank you for joining us today. I hope that we're able to answer some questions you might have on your mind about corporate taxation and optimizing income. And if you've got any personal questions, feel free to email us, Terry@zavitsinsurance.com or Justine@zavitsinsurance.com, and we'll be happy to help you. Have a good day.
Thank you.